in listen-only mode.
Well, good afternoon, ladies and gentlemen. Good morning to those of you who might be joining us from the Central Time Zones, the Mountain Time Zones, or the Pacific Time Zones. I'll also say good evening to those of you who might be joining us from across the pond, out in the UK, parts of Europe, Australia, or even Asia. So welcome to the Radioactive Trading presentation today. Some of you might have gotten the email. It went out a little bit late. I do apologize for that. Kurt will not be joining us today, so today's presentation is going to focus solely, or I should say mostly, on using the PowerOptions tools to identify, track, and manage the radioactive profit machines, the RPM setups. This is going to be more education into using the PowerOptions tools to apply the radioactive trading techniques for self-directed investors into your personal account. I'm going to spend the first 5 or 10 minutes of today's presentation just reviewing the basic concepts of the radioactive profit machine and what the radioactive methodology is, and then we're going to dive right in to the main tools. One of the things I'm not going to focus on too much today is the polls. Those of you who have attended the presentations before know that there are several poll questions that Kurt likes to ask to help him gear his presentation towards what needs to be addressed. And we're just going to focus mostly on the PowerOptions tools today, so I might ask 1 or 2 polls, but we're basically going to skip those as well. I am flying solo today, so I encourage you to ask questions as we're going through the PowerOptions tools. If you have a specific question about a filter perhaps, or about some concepts of what is being screened for, what is not being screened for, please feel free to ask the question. I may not get to it right away, but I'll eventually look over from time to time to see if there are any questions that need to be answered. But I want to encourage you to ask questions while we're going through the tools. I'm just not going to guarantee that I'm going to be able to get to them right away. Well, many of you are familiar with this screen that we're looking at here. This is part of the old presentation. I prefer to use this to show the basic setup of the radioactive profit machine, and also to go through some of the main reason, the basic reason why we're doing that, and then we're going to jump in the tools and show exactly how to search for that kind of setup, and then what we can do with the portfolio tools to track and manage the position. Now, for those of you who might be new, Radioactive Trading was developed by Kurt Frankenberg over, in 2000, 2001. Okay, I just got something here. You shouldn't be seeing that. You should be seeing, sorry, got an entrance, got a comment that came in. I only see your entrance screen. According to my view, what you should be looking at is the sort of grayish background with the Radioactive Trading, the PowerOptions logo, and then a term there that says Radioactive Trading Bulletproof Your Portfolio. That's what I'm showing that everyone is seeing. Okay, good. That's where we want to be right now. I haven't started anything yet, so we're just on the main start screen, and I'm just giving a brief introduction. Okay, so the radioactive trading technique was developed by Kurt after he had lost money doing the covered calls. He learned how to trade covered calls over a weekend seminar, lost a lot of money, and then what ended up happening is he stayed in the market and tried to develop a new methodology for him to develop, to stay in the market and take advantage of long stock positions. Radioactive trading is his term for his methodology. His full work is the blueprint. It describes his initial trade setup, how he enters into a limited risk position but has unlimited upside profit potential, and the 10 different income methods he uses off of that initial setup to lower his at-risk amount, bulletproof the position, and generate further profits. Now I say what he does, I also trade this in my own personal account. I know many of you in attendance are also trading these techniques as well. Now, the general setup, what it does is it solves a lot of problems that come along with other strategies, and we'll talk about them in a minute. But let's take a look at an old setup, and this is, I'm not showing this because it's a specific setup. I just wanted to show this because it's a good presentation of the basics of the setup that Kurt uses. Now, what we do when we enter into the radioactive profit machine, we first open any stock position, is we'll buy shares of stock, and at the same time, we're going to buy an in-the-money put option that is far out in time. Now, this does add to the original cost basis of the position. We are putting in extra money to ensure that we can't lose more than single digits on the position. Now, on April 22nd, 2009, Kurt, in his Fission account, where you can watch over his shoulder and track his positions, he bought 200 shares of GMCR, Green Mountain Coffee Roasters, at $54.20. At the same time, he bought 2 September 65 puts for 1670. Now the total invested amount is 7090. Now those of you that might be relatively new, you're going to look at this position and say that does not make any sense. You're buying a far out in time in the money put option, a put option that's about $11 above the current stock price. So now you have an investment of $70.90 on a stock that's trading at $54.20. You're not going to make a dime until the stock goes up to $71. You're not going to make a penny until the stock goes to $70.91. That was also my first argument when I saw what Kurt was doing 3 years ago. He was a client of PowerOptions, and he was using the historical tools. And on a coaching session, I showed him how to use the tools to identify these positions historically. And I said the same thing. I don't see how you're going to make a dime on this position. Well, when you look at this setup, it's sort of reversed from a standard married put. If you read any introduction to options material, you've learned that a standard married put or protective put consists of buying stock, buying an out-of-the-money put, a put that's below the current stock price. It's maybe only 30 or 45 days at a time. And you might only pay 50 cents, 80 cents, or a dollar for that insurance. And the idea is keep the cost low. But the problem with buying the out-of-the-money put is a stock might need to drop 5, 10, or 15% before the insurance policy kicks in, and that's way too much risk to take on a position. By buying the option far out in time and by going in the money, what we're able to do is enter into single-digit risk positions. So we're never risking more than 5, 6, or 7%. And also, this isn't just buying the stock and buying the put and expecting the stock to move up in price, to go to 70, 90, or to go above our cost basis in order to make a profit. We're going to make adjustments as the stock moves up, or if the stock stays stagnant, or if the stock declines in price. See, this isn't just a locked-in insurance policy. This isn't just an insurance policy that gives us an exit at $65. This put that we bought, we're also using as an asset that we can adjust as the underlying security moves up or down in price, or again, if it stagnates as well. Now here's the profit and loss chart of that GMCR position. Remember, the total cost, assuming just 100 shares in this case in one put contract, would be $7,090. The put gives us a guaranteed exit. It's better than a stop loss. By purchasing the put, we can exit the position at any time and sell to close our shares of stock at 65. So the max that we'd risk on this position is $590 or 8.3%. Now that's shown on the hockey stick graph here, the bottom of the blue line. Now, remember, this position was opened on April 22nd, and a September put option was purchased. So it was about 5 months out in time when this position was entered. When we open the RPM, it is not like buying a new car and driving it off the lot and having our value depreciate 20%. We're not at an 8.3% loss the moment we open the position. That maximum risk would really only be realized if 3 things take place. 1, we held the position all the way to September expiration. 2, we made no adjustments on the position while we were holding it. And 3, the stock was still below $65 per share at expiration. That is the only time we would really realize the maximum loss in this position. When the RPM, the married put, was first opened, the shares of stock were bought at $54.20 and the put was purchased at $16.70. Immediately after opening that position, it could have been liquidated for only a 5 or 10 cent loss. The only thing we're losing, the only thing that we're negative when we first open the position, is the difference between the bid and ask spread of the put option. So we're not down 8.3% as soon as we open the position. And of course you might look at this and say, well, my break even would have to be 70.90. Well, again, yeah, you are absolutely right. I would agree with you. If we held the stock all the way to September expiration, the stock was at $70.91, for example, we'd earn a penny, and we had made no other adjustments. The curved red line shows you what the break-even might look like at a different time. So we might only need the stock to be at 65 or 66 in order to realize a break-even right after the position was opened. And what this solves is the main fundamental of what any successful trader will tell you. What you want to do to be successful at trading is let your winners run and cut your losers short. When you follow this technique and you open these RPMs, you're starting in a position where that's done for you. Automatically, you're cutting your losers short. You can't lose more than single-digit percentage, and you have the opportunity to let your winners run. Now, yes, we did add more into the original price of the position because we're buying insurance. That is an extra cost. But it gives us the advantage to have a guaranteed exit, and unlike a stop loss, it's not a forced exit. If the stock drops, I can choose to close the position, the married put position. I can choose to adjust the put, adjust the insurance policy, or make other adjustments, income methods to the position, or I can just hold the position. If I have a stop loss and it's triggered, I'm out of the position without any other input from me. It's automatically triggered. I'm out of the stock, and if it comes back up after that, well, I missed out unless I was quick enough to buy back in. Now, just to show you what is possible with this position, remember it was April 22nd when Kurt opened it. On April 30th, the stock had moved up to $72.10. Well, remember the thought process was, well, we originally entered the position for $70.90. So with this sudden spike due to an earnings event, the stock's now up to $72.10. That really means we're only going to earn $1.20 on the position, right? Because we invested $70.90 when the stock plus the put premium. Well, that put still has value. We still have a lot of time value left in the option, and it's only a little bit out of the money now. Remember, we bought it in the money. It's only a little bit out of the money now. So when the stock had moved up to $72.10, the put was still worth $9.70. So we could sell to close the stock at $72.10, sell to close the put for $9.70, and this gave Kurt a total closing cost of $81.80. Now I don't want you to focus on this profit. For right now, what I want you to focus on is the $9.70. The stock moved up 18 points from about $54.20 to $72.10. When that happened, did the put lose value? Absolutely. We paid $16.70 for it. It's now trading at $9.70. But it is its own asset. It declined, but it only dropped 7 points. We gained 18 on one of our holdings, and we lost 7 on the other. Now, that might not look attractive, of course. You say, well, you would have been better off just buying the stock. Well, of course. And if we knew the future, maybe that's what we would have done. Some of you are familiar, of course, with the silver wheaten position we've showed recently that I was in for a 5-month period trading Kurt's techniques. And in a 5-month period, I was able to close it for about a 59.8% gain. And that is very promising. But that has, I didn't know the stock was going to do that. When I got into the stock, it was at $17.20. When I liquidated the position, I believe the stock was trading around $40 or $41 per share. If I knew the stock over that 5-month period was going to move from $17 to $41, I might have approached it completely differently. In this situation, when Kurt entered this Green Mountain Coffee Roasters position and earnings were coming up, the stock had moved up $18 from where he purchased it, but what if the earnings were poor? The stock could have dropped 18 points. Now, if the stock dropped 18 points on a $54 investment, someone who was just holding the stock might have lost 30-35%. The most Kurt would have risked on this position was 8%, about 8.3%. This is why we advocate this technique, and we trade these in our personal accounts here at PowerOptions, because the goal is to cut our losers short and let our winners run. As I mentioned, one of the main problems of any investment strategy, covered calls, bear call credit spreads, iron condors, just buying stock and hoping that it's going to move up in price, is that we don't know the future. We can't know the future. If we knew the future, it would already be priced into the marketplace to begin with. Now, this particular position, this is XL Maritime Carriers, is one of the volatile shipping stocks, Greek shipper stocks. And Kurt entered this position at one point as an RPM, where he had a limited risk, I think, of only 6 or 6.5%. Now, there are many opportunities here to make money on the stock. If we bought here at one of the lows and we were able to sell it here at one of the peaks or hold it even to the second peak at this little double top here, we'd have a very significant profit. However, if we timed it wrong, maybe we buy here at this low, we missed the first low, buy here at the second low, it goes up, but we want to see a little bit more, and then the stock drops down. We might have been closed out at this point due to a stop order or a stop loss. Of course, if we did the opposite, if we were considering shorting the stock, and maybe we wanted to short it here, we'd make a reasonable profit if it dropped here, but if we're expecting it to drop further, and then this event happens, well, now we're in trouble. And this is the key. Because we don't know the future, we have to make sure that we manage our risks. We focus on limiting our risk first and having a guaranteed exit instead of a stop order, which is really assumed insurance. It's not a guaranteed exit. It's really a market order to close you out of the position. And of course, covered calls is one of the popular techniques that are used. And I'm not going to spend a lot of time discussing or downplaying covered calls as a strategy. I traded covered calls for a couple years when I first started, and I suffered the same thing many of my customers have suffered. I've been with PowerOptions for 8 years. And what covered calls end up doing over the long term is it ends up as a sorting machine. You're looking for stocks that you feel are bullish. It is a bullish to neutral strategy. You're expecting the stock to move up in price. You're going to sell a call that gives you a premium. You collect income in to lower your cost basis on the stock. And by selling that call, you've entered an obligation to deliver your shares of stock at a set price. Now, if you picked right and you picked a good bullish stock and it moves up 7, 8, or 9%, what you've done is you've capped your gain. You might only make 2.5%, 3%, maybe even 3.5%, but you're watching the stock continue to move up without you because you have an obligation to deliver the stock. Of course, can you roll the call? Yes, you can, but it's going to cost you money to roll the call after it goes above your current strike price of your call. You're going to be adding more money in the position and hoping for a higher payout by adjusting the call and collecting a new premium. But a lot of times if the stock takes off and is bullish as you expect and it moves up 8 or 10%, you're going to be rolling for a debit and then hoping to get assigned at a higher strike price further down the road. And the problem here is that your winners get called away from you from a smaller gain. And what does the bottom show us here? What's the problem with the downside? Well, if we have stocks that move up 10% and get called away from us from 3%, we might be happy with that return. But then if our other stocks in our portfolio, half of our positions or maybe even a third of our positions dropped 10 or 15%, we might be on the hook for that full loss. It's a sorting machine. The losers end up staying with you and the winners end up getting called away. It doesn't follow that axiom of cutting your losers short and letting your winners run without aggressive management as the stocks are fluctuating in price. So what the radioactive profit machine, the protective put, the unique setup we use for the Mary put position, forces us into a position where we're cutting our losers short. We can't lose more than single digits on the position, and then we still have an unlimited upside profit potential. This is our starting point. This is where we're going to start. We saw this similar example, the similar 5-line setup with the GMCR position. We're going to buy shares of stock at a certain price. We're going to look to buy a put option that's in the money and out in time. This is going to increase our investment. We are going to pay into the position, but instead of looking at it as just an insurance policy, these are technically 2 securities that you own. You can manipulate the put option as the stock moves up, moves down, or stays stagnant, or you can do other income methods off of it, keeping your risk low and lowering that risk by generating income and not increasing risk to your position. Of course, we're going to get to that in just a little bit when we look at the portfolio tools as well in PowerOptions. So the idea here is to limit our risk, let our winners run, and make adjustments as we go forward to lower this original at risk, to pay for this at risk, cancel this 4.4% at risk, and eventually be at a place where we call being bulletproof, where I've canceled my at risk, I still have my insurance policy in place, and an unlimited upside profit potential. All right, so that's the quick 15-minute review of the radioactive trading principles, why we advocate them here at PowerOptions, and why Ernie, myself, and the other staff members here at PowerOptions trade this technique in our personal accounts. Now let's get to the PowerOptions tools. PowerOptions, of course, is a patented suite of search and analysis tools designed for self-directed options investors. Those of you who have purchased the blueprint, as you go through the blueprint and the different sections, you've seen screenshots of PowerOptions, the search tool, for example, the option chain perhaps, the search by symbol tool, and the portfolio tools. Now, the great thing about the radioactive trading techniques, the discussion in the blueprint, it is not a step-by-step set of strict rules to always only buy stocks that have this, only buy put options that have A plus B plus C, and always have a risk that's here to here. Well, that kind of is in there about the risk factor. We don't want to take any risks more than what we can stand in our personal account. You really want to keep it to single-digit risks. But the concept of what's in the blueprint, the concept of radioactive trading, is the idea of how to manage your positions to force yourself into a proper position and then be able to apply the income methods on top of a stock selection process you might already be using. But to get you started, when you first log on to your PowerOptions account, what you'll do is link to the Married put menu. Of course, we support 23 different strategies. You see we have married puts and collars and covered calls listed here. But to identify new positions that I'd like to open, we're first going to go into the married put menu, and I'm going to click on the search tool. Now the search tool, this is going to scan the entire universe of options. Okay, hold on one second. Luis wanted to know, can we follow with our account while you present? Well, if you have two windows open, Luis, you can probably do that. And if you're comfortable just listening to the voice without seeing the screenshots, I'm sure you could log onto your account, have it open in a separate window, and follow it. That won't cause any problems if you want to try that on your computer. Okay. When we go into the search tool, what the system did is scanned across the entire universe of optionable stocks, indexes, and ETFs, and identified only those positions that matched a basic criteria. Before we discuss the criteria, let's just review what we're seeing here. This is the basic view, the default columns that are selected in the married put search. So we start off with our basic components that we would need to know, the basics we would need to know when looking to open one of these RPMs. We have our company name. Start off with Edward Life Sciences. Stock symbol is EW. Current stock price is $78.70. And we're shown we can buy the 2011 August 90 put. So we're about 12 points in the money, about $11.30 in the money, and it has 226 days to expiration. Now the ask price for our put option is $14.90. Okay, so we're adding $14.90 into the purchase. Now this makes the total cost of this position, this strategy, this particular one on Edwards Life Sciences, $93.60. But remember, what am I purchasing? I'm purchasing a 90-strike put, which gives me the right to sell to close my shares of stock at $90 anytime between now and August expiration. So the most I can lose on the position is $3.60, my total net debit minus the strike price of the put, and that works out to be 3.8% of my original price. My original net debit, I should say, the stock price of $78.70 plus the 90 put. Now remember the three factors I talked about as regarding the maximum risk. My maximum risk is $3.60 if I open this position. The only time I'd realize that maximum loss, well, there's a fourth time, but the only time I'd realize that maximum loss is if the three factors were satisfied. If I held it all the way to August expiration, the stock was trading below $90 per share, and I made no adjustments over the next 226 days. It's the only time I'm going to realize that full risk of $3.60. There is an addendum to that. If this stock completely collapsed, lost 60, 70, 80% of its value for some unforeseen reason, it dropped down to $10 per share, $15 per share for some unexpected event, I'd probably be really close to this maximum risk as well. It might be only lost $3.55. There might still be 5 cents of value. But in a complete collapse, yes, I'd be close to that maximum risk as well. But think about it this way. And that type of black swan event for this particular stock, if it dropped down to $10 or $15 per share, if you were trading a covered call, where would you stand? If you had done a bull put credit spread, where would your position be? If you shorted the stock, of course, you'd be looking pretty good. But that's the idea behind this, is that even if there's a complete collapse, something completely unexpected, we're still only going to risk 3.8%. And before we go into the parameters, let me just link over from the More Information menu where I can do further research and analysis, look at the stock chart, the company information. What I want to do is link to the profit and loss chart for this particular EW position. Now, what does this show us? Well, we have our listing here. If we just did 100 shares in one put contract, our total investment would be about $93.47. We are guaranteed an exit of $90. Now this changed a little bit because it's real time. From the search results to when we linked over to the profit and loss chart, these numbers changed a little bit, but it's still the same. So our monetary risk is $347 or 3.7%. Do I have a break-even number? Yes, I do. $93.47, and that's only at expiration. Again, hold it all the way to expiration, 226 days, make no adjustments on the position, and the stock's trading right at $93.47 would be a break-even. What's interesting about this, the stock's currently at $78.57, and this curved red line shows us theoretically what our position would be would look like, at the halfway point on April 29th. Well, look at that. That's about 85.50. So in about 110 days from now, on April 29th, do I need the stock to be trading at 93.47 to make a profit? No. Probably only need the stock to be trading around 85.50. The put will still have time value. Our stock has moved up in price. And because the put is still far out in time, we would not have seen that much decay in your position. Okay? And that's what we just wanted to illustrate. Now there's another feature we can do. What happens if the stock moves up, let's say, 2 points? Let's say it moves up to $80.50 in the next 2 weeks. What would our position look like? Well, we can simulate that here on the profit and loss chart. So I'm going to put in just 80.50. And let's just say a couple weeks from now, so let's go to the 21st, shall we? What would my position look like if EW moved up $2 to $80.50 in 14 days? Well, it now redrew the profit and loss chart for us, and our curved red line is showing us what our position would look like, theoretically, of course, using the Black-Scholes pricing model on December 21st. Well, we'd have a gain of $193 on the stock, and we'd expect a loss of $207 on the put. Well, that would give us an expected loss of $14. But remember, our maximum risk was $347, so we're getting closer to that profit level just with a 2-point move over the next 2 weeks. The break-even at this point is kind of looking at around $81. Let's just see that. I bet you actually it's $80.75. So 2 weeks from now on the 21st, let me just plug in $80.75, a little bit closer. I know I'm playing with numbers. I'm going to get off of this in just 1 second. Let's try $80.90, shall we? All right. So it looks like, just based on the Black-Scholes pricing model, is that $80.90 in the next 2 weeks, 14 days, and we'd be at break even. Are we anywhere near $93.47? No. We're not. We don't need the stock to rise to that price, all right? We just need to see small movements, but that's not what our objective is. We're not planning on holding the stock and just having it shoot up in price and make a profit when we open up one of these positions. If that happens, as it did in the GMCR example I showed you, fantastic. We'll be able to take the profits because we didn't cut our winners short. We didn't enter in an obligation by selling a call that would cause us to deliver our shares of stock or obligate us to deliver shares of stock at a lower price. We have an unlimited upside profit potential to take advantage if the stock takes off. All right. So, real quick, let me address a couple of things here. Ron quickly said your risk might be less for a black swan because volatility will increase. You're absolutely right, Ron. If it dropped, in this example, if Edwards Life Sciences dropped $15 or so, my volatility on the put would increase. So I might actually see a gain in the time value of the put option as time passes because of that increase in volatility. What I was referring to is an extreme drop. If this drop died in $10 per share, the volatility might spike, you're right, but we're so deep in the money that we're going to be close to parity. But you're absolutely right. So that is very potential. And Jerry wanted to know, unfortunately he was having some sound issues. It was cutting out on him. I apologize for that. It looks like everything's been coming through fine. But he wanted to know, is this presentation going to be archived? Absolutely. I'm recording this presentation. We'll have it up later on this afternoon. Okay, Jerry? And please feel free. And one other question that came in right now that I'm going to get to, and I know some of you might think I'm beating around the bush here, but I'm getting to it. What is it? Chuck asked, can you do this for ETFs? Yes, that can be done. Remember I said it can be applied to your existing stock process, but there are some things you want to be aware of that are discussed in the blueprint, Chuck, about how the ETFs perform. And of course, this is, John wanted to know how far out in time usually do you do the put. I assume you're getting to that, and that's right. I'm going to address both John and Chuck's questions right now. We have these results. It matched a default set of criteria when I first opened the search menu. But what were those criteria, and why were they selected? See that? We're going to scroll down below the listed trades. Below the results table, we have our parameter field. In the parameter field, we have a listing of about 20 to 25 different option criteria and about 25 to 30 different stock criteria that you can use in conjunction to identify just those positions that match your risk-reward tolerance. What we're going to use is the radioactive default search. You see up at the top here I have the radioactive default search selected in the search settings saved as menu. If you just started a trial, when you first log on to the account, you might see an initial value set as the default setting. To change that, simply click the drop-down menu and select Radioactive. These are the general criteria, the starting point criteria that Kurt uses to identify his positions. As discussed in the blueprint, what are we going to look for? Well, first, we're sorting the results by the lowest maximum risk to highest. Okay? We'll talk about that in just a moment. As far as the time frame, John, what we're looking at here is we've set our option expiration time frame for all months. In the blueprint, Kurt discusses the 3 core principles of radioactive trading. The radioactive decay line, what he calls the red line, the force ideal size trade, which we've already talked about, putting ourselves in this position forces us into an ideal size trade, and the at the money bell curve. Now what we're taking advantage of with this concept is the radioactive decay line. We're looking for put options in the wide range of expiration months, but that are at least 150 days out to expiration, at least 5 months out in time. Now that's just a starting point. As you continue to trade or you continue to research potential RPMs, you might feel more confident going 250 days out in time. You might feel comfortable going at least 8 months out in time, for example. And you can change that simply by adjusting your days to expiration. So I might change this to 220 to 900 days, for example. To answer your question, basically, John, start off with at least 150 days out in time, at least 5 months out in time. This takes advantage of that radioactive decay line, where we know that if we buy an option, we see the rapid time decay, the main crux of the time decay, happen in that last 60 days, that last 2 months to 75 days. When I buy a put option that has 5 or 6 months out to expiration, the first 3 months, the time value is going to decay very slowly, and then that rapid decay comes at the end. So we're looking for positions where we can take advantage of that slower time decay. Start off at least 5 months out in time, and you'll be able to fine-tune what you feel your preference is based on performance. Now, the other criteria that starts off at the basic point is just the range in the money. And the radioactive search is not allowing the puts to go more than 20% in the money. There's a reason for this, and I'll illustrate it in a little bit when we go to the search by symbol tool. There is such a thing as taking on too little risk. As we talked earlier, the question that was asked about, well, if the stock dropped that far, the implied volatility would shoot up. Well, sure, but I had mentioned you're so close to parity. If I bought Edwards Life Science right now, as we saw earlier, at $78.57, and I found a put option that was up at the, let's say, 150 strike 5 months out in time, well, that put option is going to be trading right at parity. It's going to be trading right at $72, $73. So sure, I might invest in a position by buying the shares of stock at $78.50, and let's say buying the put option for $72.50, so my total investment would be about $151. Oh, and I have 150 puts, so I'm only risking $1, or about 0.4, 0.3% on the position. Okay, well that sounds great, doesn't it? I've really cut down my risk. What's the problem? Well, the expectancy of any profit, if I own a put that's almost 100% in the money, is essentially zero. I mean, I would need the stock to be trading around 140 or 145 in order to reasonably expect to make a profit on the position or apply an income method correctly. Okay, so there is such a thing as going too deep in the money, which is why we are restricting the range in the money to be less than 20%. Again, this is not a recommendation or suggestion. These are just the general criteria that Kurt discusses in the blueprint. What has worked for him? And then we can adjust this. Now, the percentage maximum risk, we're only looking for a range of 3.5 to 9%, and the open interest, basically zero. Everything in the center section is mostly your combined calculation terms, the max risk, the percentage max risk, and your option criteria, implied volatility, delta, open interest, liquidity for option volume, and so forth. Why don't I have a lot of criteria in here? Why don't I have anything in there for delta or for implied volatility or volume or open interest? Because we're making this a basic search. Now, the delta range and the implied volatility, that's kind of already taken care of by my maximum risk. Someone might say, well, why do I need to, wouldn't I need to restrict positions that have a lower implied volatility because I don't want to have an implied volatility that's too high? Well, yes, but if your implied volatility was too high, you would be above a 9% risk. You'd have a much higher risk because the put option would be inflated. Even though we're not using a filter for implied volatility, it's already factored in with the maximum risk. As you tweak your maximum risk, your personal maximum risk threshold between 3.5, 3% to 7%, 3.5% to 8%, whatever you use for your personal threshold, excuse me, ladies and gentlemen, that's also going to affect the delta. If I used a limited range of looking for maximum risk between 4 to 7%, I'm probably only going to have all my deltas are probably already going to be filtered to be between maybe negative 0.6 to negative 0.75. It's already going to be factored into the positions there. But, Ken, I'm going to get to that position. I'm going to get to that in a second. Ken wanted to know, does the data for the criteria stay after logging off, or would I have to re-enter it every time? Once you make some changes, which we're going to do in just a minute, basic changes, which are not recommendations. I'm not saying everyone should potentially trade the same way that I do. But you'll be able to save the search. Up at the top here in that search setting saved as menu, there's a save button, and that's going to allow you to save your search. You're going to be able to give it a name and a description, and you'll always be able to toggle between your saved searches. For example here, Ken, let me make sure this pops up correctly. There we go. You see I have other searches saved here. The October 27th search, which was done during a webinar, and a save search criteria that was done on Tuesday, October 6th. So I can toggle between these searches or the original default searches at any time. You have the ability to save as many searches as you want. Okay. So that's just some of the description in the center. And of course you can increase everything. Let's talk about that. Maybe I want to make sure that my open interest is at least 10 contracts, so I'll just click in the open interest field, change that greater than 0 to 10. And let's say my personal threshold is that I want to have a risk of less than 7%. You just click in the field and put in what you want to see. Now I mentioned that we have about 25 different stock criteria. A basic view of a stock price between $9 and $200 per share. Well, that's what Kurt looks at. In his fishing account, he's over $100,000, so he might enter into a stock that's trading at 150. My personal preference, or not preference, but my personal availability, based on the money I'm trading the radioactive profit machines with, is to look for only stocks that are between about $5 and $55 per share. So I'll just go ahead and make that change. What suits me? What kind of positions, what kind of protection am I looking for, and what kind of stocks am I looking for? Now, of all these criteria I keep talking about, you notice there's not a lot of information put in for things such as the fundamentals, earnings per share growth, price to earnings, broker recommendation, beta, market cap, for example. There are a couple of filters for the historical volatility of the stock to be greater than 0.25 or 25%, or the average stock volume of at least 300. This is measured in thousands, so it's looking for at least 300,000. Are we leaving the criteria wide open to see a whole listing of stocks that have that minimum risk and open interest? Well, Kurt's preference, as I scroll further down, Kurt's preference is to screen only against stocks in the IBD 100 and canceling list. I'm not going to go into why he selects that. It's described in the blueprint. And of course, we also have some technical indicators you can use. The RSI field, for example, Bollinger Band ranges and Bollinger Band widths. And we're specifically looking for stocks that are trading it above their 50-day moving average, stocks that are trading in an uptrend. Well, the key here is that you can use the IBD 100 and cancel in list if that's a list that you follow. But you can also select other stock lists as well. You could screen just against the Dow 30 Industrials. The volatility on those is kind of low, so it might not be an opportunity to apply a lot of income methods if the stock is moving more slowly. But as I scroll down further, I could select perhaps the S&P 500 stocks, or I could select the S&P 5-star stocks. You can also click on the link here for create and modify lists to create your own personal stock list. For example, I have some things in here called example list or large combined list. Oops, sorry about that. Or my example list as well. So you can create your own personal stocks. If you have a group of just 15, 20, or 50 stocks that you track, you can create your own personal list and then screen against the married put positions that match that. So why aren't we using a lot of the criteria that we have available? Well, because a lot of that's already taken into account if you have selected one of the stock lists. Probably good earnings, good beta, or lower, or an average range of volatility, for example, probably would have already been factored in for the stock to make it into the IBD 100 or the canceling list. Now, can we open this up to a wider view? Absolutely. I can go ahead and select no lists from that recommended list drop-down. I'll leave this range for simple moving average. And now I can put in other stock criteria. I only want to see stocks that have a 5% earnings per share growth, that have grown 5% in earnings from last year to this year. Maybe I only want to see stocks that have a PE ratio of 0 to 50 or maybe 0 to 70. You want to use a percent of 52-week range or broker recommendation. If you wanted to look for stocks that paid a dividend, I'll just put in only those stocks that pay at least a 1% dividend. Just see the dividend-paying stocks. And I'm actually going to make a subtle change here to historical volatility as I do that. And maybe I have a higher range for average stock volume. Let's say I only want to see stocks that trade at least 700,000 shares per day on average. Once I've made my changes, we just scroll up to the top and click Submit these settings. System's now going to rerun the search and identify only those new positions that match our criteria. Now, I still have the same basic columns selected. I know my stock symbol, the last price of the stock, my days to expiration, the strike price of our put, the option ask price, open interest is there, that's good. The total cost, the net debit, the maximum risk, and the percentage maximum risk. Remember, we selected some other criteria that we wanted to view. We had open interest there, but I also wanted to see stocks that paid a dividend, didn't I? Put in some fields for the earnings per share growth and the price per earnings. Well, if I want to use that as part of my comparisons, what I'll simply do now is above the results table, we'll click on that See More or Less Columns button, and this will take us to the configuration page. Any of those filters that we can screen by, down below to identify our positions, we can select to view in our results table. So I could select delta or implied volatility. What I was looking for here, well, we already had the open interest selected, so I don't think I need anything right now in the options page. But some of the things I wanted to see, we talked about the earnings per share growth, the price per earnings. I also want to scroll down a little bit here and look for the dividends and the percent dividend yield. There it is, right there. Okay, so I'll just pick and choose which columns I want to see, and we'll scroll down to the bottom. I can choose to reorder the columns once I've checked those new data points I wish to see in my results table, or I can simply click Save and Return. Now let's click Save and Return. We're going to be prompted to refresh the page so that we can reload that as well and get the new data. All right, so let's refresh that. John, you're just one step ahead of me. As I'm going through this, you're just one step ahead of me. Absolutely. John wanted to know if I look at the stock chart. Absolutely. Okay, so what have we done so far? We started off with a default criteria set for the radioactive trading method that's based on the concepts in the blueprint. We made some adjustments to our percentage max risk, our open interest. We changed some of our stock filters, and of course our stock price based on the stocks that we'd like to trade, to identify positions that match how we would like to invest, the stocks we would like to invest, and of course the minimum risk we wanted. Now down below, we are just showing the top 20 results, and remember I've sorted it by lowest maximum risk to highest. We start off with 3.6 on the first page, the first 20 results, we go to 4.3%. But down at the bottom, you see that we have a total of 126 results. This might be too many. I might further increase some of those criteria I was using to filter this down to a more manageable number, maybe less than 40, maybe 45, somewhere in that range, maybe even only 25, for example, 2 dozen or so. And John, this point that you brought up is the next step. So here's my position. This is the top one, Archer Daniels, 31.67. I could buy the June 35 put for 4.65. My total net debit is 36.32. I have a maximum risk of $1.32 because we own the 35 put now, or 3.6%. The stock matched my criteria. It has the lowest risk. Am I going to jump in and place this trade right now? Absolutely not. Now we want to further research and analyze the position. There are other things we want to look at. First step, I personally do. This doesn't have to be your steps, but the first step I'll personally do is I use the More Information button over on the left, as we did before, to look at the profit and loss chart. And what I'm going to do is go to the chart. I can take a look at the one-year snapshot or big charts. Now, of course, we like to use big charts. It's a free charting service, and you can customize it using different criteria. Over here on the left, I can change my time frame if I wanted to go to a 2-year or just a 6-month chart. I can use different indicators over here on the left. So if I wanted to look at EMA lines or SMA lines, for example, if you like to compare it to Bollinger Bands or price channels, you could select that as well. And also things such as the RSI, MACD, slow or fast stochastic. You know, you can select different views here on big charts to analyze your position. I think you can, chart style, of course, you can go into candlesticks or you can go into other charts. What am I mainly looking for here? Let's go back to the very beginning very briefly. I mentioned that this methodology can be applied to your current stock selection. We're looking for positions that we're expecting to move up in price. It is a bullish strategy. I'm not going to sugarcoat that. We are expecting the stock to move up. The 10 different income methods allow us to make different adjustments, lower our risk, or perhaps lower our break-even if the stock does move up slightly, maybe moves up but doesn't go up as high as we were thinking, if the stock stays stagnant, or if the stock declines in price. So what am I doing when I'm on this chart? I'm looking for a chart or a pattern, using whatever indicators I use, that I feel confident that this stock is going to be moving up in price, maybe moving up 5 to 8%. A loose expectation that the stock might move up 5 to 8% in the next 30 to 60 days. Is there a guarantee that that's going to happen? No. It's a great reason why I'm buying insurance, isn't it? Because I don't know the future, but I'm looking for a position that I feel confident might move up in price over the next 30 to 60 days. Well, if I look at this chart and I decide I'm not confident that this is a stock that I feel is going to move up, I'm just going to close the chart. Technically, I'm done with that position. Yes, it matched all of my stock criteria. Yes, it has the maximum risk I'm looking for. But if I'm not confident with the chart, I'm done with Archer Daniels. I'm going to move on to Teva now. Let's take a look at that one. Just go to the second one. Still is in my risk range. Still has the stock criteria that I'm looking for. Use the More Information button, and we're going to go back to big charts again now for Teva. And again, we're just running that same process. Is this a chart that I feel comfortable with of a stock that I don't think is going to drop out of bed or fall out of price, but more importantly, that I feel might have a chance to move up over the next 30, 60, or 90 days? I keep noticing that there are some delays with the page refreshes, and I've gotten a couple comments that the sound is cutting out. I do sincerely apologize for that. I am recording and archiving this presentation, as I mentioned. I think it's an issue with the GoToWebinar technology because my screens are coming up very quickly. I just think there's a small problem with the GoToMeeting, GoToWebinar technology, and I apologize for that, and I hope the recording will be much better. All right. Well, let's go back to our main search screen. For the sake of argument and for the sake of time, let's say that when we looked at that Archer Daniels chart, I was comfortable with the chart pattern, and this is a stock I want to further analyze because I feel it's going to move up in price. Okay? My second step, after I look at the stock chart, is I am going to look at the company news and information. I'll be honest with you guys, I've heard the name before, but I don't know exactly what Archer Daniels Midland Company does. So I might want to go into the company news and take a look at the profile. What is their industry? What is their sector? Certain things of that nature, get more familiar with the company. I can check out the last earnings events. You can also see that on big charts. And also, I want to look at the recent news headlines. Why? Well, if there's any discussion of a boardroom scandal or a boardroom power struggle or any kind of buyout, or they're buying a company out that might want to research further because I don't feel it's a good move for this company, buy out the other company, that would cause me hesitation to enter the position. So identify your positions by your criteria. Take a look at that stock chart. Analyze it based on what you usually use to identify a bullish stock or a stock you feel is going to move up in price. Take a look at the company information, the news, and the headlines. Now, in this particular screen, I don't see any duplicates. And what I mean by that, well, you can't see duplicates anyway, but what I mean is ADM is at 3167, this position we're analyzing, and we're shown the June 35 put, which has 3.6% at risk. But my threshold is up to at least a 7% risk. When I looked at that chart and I said, well, I feel the stock might move up in price over the next 30 to 60 days. It might trade around 33 or 34. I wonder if there's an opportunity with the 32.5 strike put. Is there anything I could find with a lower strike put for June? One of the examples, let me see if I can find one in here that shows that. Wow, I'm having problems today finding what I'm looking for, but that's okay. So sometimes on the same list, you'll have, for example, we might have ACN, and we have the 52.5 put, but if we go further down the list, we might see another ACN with the 50 strike put. So after I've looked at the stock chart and the company news, what I'm going to do is link directly from the search menu again, using the More Information buttons, to the Search by Symbol tool. This is one of the other tools that's available under the Married Put tab. And if you just, when you logged on, if you were interested in opening a Married Put, let's say on Apple or IBM, rather than going to the search screen, we would have gone into the Search by Symbol tool here to compare the other positions. Now these would have been on the other page. If I would have gone to page 2 of my results, I would have seen these. Are you seeing what I'm showing here? We have the June 35 put. It's highlighted in red, 3.7% at risk. This is the position we were looking at on the search tool. But notice that I have 3 other married put opportunities on ADM that match my risk threshold. Now, all 3 of them have an open interest of greater than 10%, or I'm sorry, greater than 10 contracts. That was one of our other criteria. But, I have this position here. I could buy the 34 and have a 4.7% at risk. That's still within my range. The 33 strike put has a 5.7% at risk. That's definitely still within my range as well. So when I looked at that stock chart, if I liked ADM and I felt that, okay, I feel confident this stock might move up over the next 30 or 60 days, but I think it looks like it might be trading around $33 or $34, if I use the 33 strike put, I am taking on more risk. I'm taking on a 5.7% risk instead of a 3.7% risk. But as the blueprint discussed, the best time to make one of the adjustments, the best time to look at one of the income methods is when the stock's trading right at the put strike price. So I feel more confident the next 30 days the stock might reach $33 and I would look to apply an income method. I might be comfortable taking on a slightly higher risk, 5.7%. However, if I'm more conservative and I think the stock's going to be a growth stock over time and eventually it'll get to 35 in a reasonable term, 60, 65 days or so, I might want to stay with that lower at-risk amount. So based on your expectation of the stock, what Kurt always refers to as the SIGA model, your expectation and your goals is going to help you determine which strike you'd select. Now these other 3 strikes that we've seen here, the 34 strike, the 33 strike, and the 32, were in our search results. They just weren't on the first page. Remember? So let's go back to our search menu. And the highest maximum risk in our first 20 results is 4.3%. So that's 34 strike on ADM that had the 4.7% risk, and the 33 that had the 5.7% risk. Those would be on page 2, for example, and page 3. All right, so far we came into the search. We started off with the radioactive default criteria. We made some adjustments based on what we would want to look for. We used the See More or Less Columns button to add those columns into our results to help with our research and our comparisons. Then we used the More Information button to take a look at the stock chart, company information, the news, and the profile. And then we use the Search by Symbol tool to evaluate between the different strikes. Now my very next step when analyzing a position is kind of what we already did. What I'm going to do now that I've done that other research on the position, I'm still comfortable with the position, I think this is a good trade, we're going to link to the profit and loss chart. Why? Well, I want to run some what-if scenarios again. Okay, so I have my profit and loss chart. The blue line is showing me the maximum risk. Again, most likely only achieved if I held it all the way to expiration, made no adjustments. The curved red line is showing me the profit and loss at the halfway point. As we did before, down below the profit and loss chart, I can put in different values to calculate the expected profit and loss if the stock was trading at a certain price within the next 2 weeks or within the next month. You can do the reverse. What would happen if the stock dropped? Our ADM's at $31.71. What would happen if the stock dropped to $29 per share? What would our maximum risk be? You can run those what-if scenarios with a calculated expected profit and loss field. In addition to that, if you wanted to run the monetary numbers of if you traded this with 400 shares or 500 shares, simply scroll up to the top of the profit and loss page, and you'll see that your 2 legs have been entered for you from the search menu. You have 100 shares at $31.71 and buy 1 put at $4.65. Well, let's just change that. We're going to do 400 shares, and we're going to do 4 put contracts. Oops, sorry, hold on 1 second. Okay, let me make sure that we're seeing the same thing here. Okay, good. So once I've changed the quantities, now I simply want to do is just, there it goes, I'm sorry. It's being really slow. I'm trying to watch the audience view pod on my menu at the same time I'm running these screens to make sure you guys are seeing the same thing I'm seeing and the pages are refreshing correctly. So right above the profit and loss chart is where you have this 4-leg entry. Those 2 legs were copied over for you. So once I change my quantity, we'll just click Submit. The profit and loss chart is going to look very similar. The ratios of our gain to loss and so forth, that's going to look very similar. All that we've changed really is the monetary values. So now instead of having invested $3,000 into the stock and $465 into the put, we've invested a total of $14,544 with our 400 shares of stock. Okay. I know that many of you are experienced options traders or that you've learned covered calls. You maybe looked at spreads and so forth. One of the first discussions that we receive when we're looking at the profit and loss chart or we're discussing the radioactive technique is, hey, I know covered calls. I see what you're doing here. You've limited your risk. You're trying to take that lower end out of the equation so you don't suffer any bad news or any kind of drop in the stock of 10 or 15 or 20%. But if you only have a, in this case, a 3.7% risk or $544 for 400 shares, when you purchase the 35 put and the stock's at 31.73, why don't you just sell the 33 call right now? Sell a call right now, get some premium, lower that at risk right away. What's the axiom? Cut our losers short, let our winners run. Let's quickly simulate what would happen. In this ATM position, what would happen if I sold a call right now? To simulate that, up at the top where we have that 4-leg entry field, I'm going to go ahead and click on View Options, and this will pull up a collapsible chain for us for ATM. I'm going to go ahead and select the February series because January only has 16 days to expiration, so the premiums are probably very light. So let's go ahead and select February, and it shows me the available calls and the available puts on the left. I mentioned the 33 call. It's slightly out of the money, and we see the 33 call has a natural bid of 78 cents or 81 cents on the natural ask. All right, well, I'm going to simulate selling this call right now against the RPM I just opened. So I'm going to click on the 33 call, the text link, and it'll show me that it's been added. I scroll down, and we see that it's now the details for my February 33 call are now in the third leg. I'm going to change the action to sell, and of course put in my quantity of 4 contracts. And then we'll click submit. I'm just going to leave the price alone. It's going to grab the natural bid price for my short February call once I put that in. And now we scroll down below, and there's our profit and loss chart. This is what happens if I sell a call below the put strike price and too soon. What have I done? Well, I've capped my gain. As we see up here, the maximum percentage return now on this position, if and only if the stock is trading right at 33 on February expiration, is 2.4%. That's probably not going to match my goals and my specifics for this position. I'm expecting the stock to move up in price. Oh wait, there's something else strange here. My maximum risk is now 7.3%. How did I increase my risk by selling a call? I had a married put position. I had a guaranteed risk of only 3.7% or $554 for 400 shares. How did I increase it to 1,000 or 7.3%? Well, I didn't increase it on the downside. My downside risk was lowered. This was lowered based on the premium we received. My risk is now on the upside. Our total investment would still be around $36, right? We had about $36.35 invested with the stock plus the put, and we lowered that by 78 cents. So our total in the position is going to be about $35.80, $35.90, let's say. Okay? But by selling that 33 call, if the stock takes off unexpectedly, if it moves up to $37, $38 per share, what's going to happen? My put's going to decline in price. I'm obligated to deliver shares of stock at 33, and I've got an overall investment in the married put of about, or in the whole collar position now, of about $35, $36. So I took my risk up almost to $3 per share on the upside, the direction I was planning the stock to go in the first place. Giving a little bit away here, this is why in income method number 1, the rules for income method number 1, selling a call against the position, we discuss not selling the call too soon. You never want to sell a call below the put strike price, and you want to wait for the stock to move before doing an adjustment. We almost doubled our risk on the upside by making that adjustment. That's not what we want to do. That's not what we want to achieve. All right, so this is why I go to the profit and loss chart, run my what-if scenarios, and if I have something in the back of my mind that says, what if I sold the call now? What if I did this? I'm going to simulate that first graphically before I enter into the wrong type of position. All right, let's close that down. Let's go back to our search menu. Very last step. I'm not going to go into the very last step. Now, we're going to go a little bit over, ladies and gentlemen. I apologize. I want to get everything in, and there's a lot to discuss here. We are going to go into the portfolio tool in just a minute, but I wanted to touch on 2 different things very quickly. We're going to go back to the Archer Daniels in a second. I just wanted to point out some of the features. As I believe it was Ken, Ken asked the question earlier. Once I put in my criteria that I used, if I want to save this now, I just click the Save button at the top of the screen, and that'll prompt me to enter in a name and a description for my position. So I'm going to put in my search name as, let's say, January 7th, 2011. And my description, let's just put in first adjusted RPM search of 2011. I won't put in any specifics, but you can just type in a name and a description, and then click the text link that says save this search. And now it just reran the search for us, but at the top, when I scroll down below the list of trades again, now that new search is saved with the default searches and my other saved searches. So you can save as many searches as you like, and you'll be able to reference them. If I logged out right now and logged back in, it's going to remember the exact same search that I left on, so it would still pull this up. There's another, Sue asked, or this is probably Jerry, Sue asked another question, something about a price that's too high. I'm going to get to that in just a moment. Another question that came up earlier was regarding, can you trade this on ETFs? Absolutely. And the easiest way to do that is when you first pull up the default radioactive search, what I would do is take out some of the stock filters, such as maybe the average stock volume or the historical volatility, and then at the very bottom in the recommended lists, instead of screening against the IBD 100 and CanSlim list, I'd select just the indexes, ETFs, and holders. So you'll be able to identify those positions that match the index, ETFs, and holders lists, the married puts that match that criteria. I had mentioned earlier, this is a more advanced concept that Jerry or Sue asked me about how can I determine that the option is not undervalued or is not too overvalued. Well, that's already taken care of based on this menu. Okay, so when I selected the maximum risk, if I'm limiting my maximum risk to less than 7%, I know that that option is not inflated. However, there are some concerns that the option might be near its higher of its implied volatility range, and I'll use the percent implied volatility range to filter that out. So that's just one way that you can make sure that the option's not near its implied volatility. Nancy asked a quick question, will the save search display old results when you run it again in the future? No, Nancy. This search tool is only identifying positions that match your criteria in real time. We're looking for new positions right now. That's what the patented Smart Search Excel does. It finds positions right now. If you subscribe to the historical suite of tools, I can go into the historical married put search and pull up this particular screen, the January 7th, 2011 screen, and select to run this criteria any date back in time to April 2006 and see which married puts would have matched my results, and then I can simulate those results forward and see how they performed over time. Steve, I might get to that in the end. We need to get to the portfolio tool now before we get stuck on this conversation of volatility and everything. But I'll try to address that, Steve, at the end of the presentation. Now notice we did have a little glitch. I don't want to say glitch, but when I saved that search and it reran my search for us, the Archer-Daniels position is no longer the one with the lowest risk. We have just now a 3.7% at risk, but Lowe's, Antiva, and Starbucks are now listed as lower maximum risk than our original position. But sticking with the Archer-Daniels example, we went to the stock chart, we looked at the company information, the news and the headlines. I took a look at the profit and loss chart as well to run my what-if scenarios, and we also compared it using the search by symbol to see what other strikes and other risks existed on that particular stock. Now, the last step, of course, I might go ahead and place this trade. If you're using Options Express or Brokers Express, you can go to the broker link, and you can choose to select enter as a married put, or you can leg in a position by buying the stock or buying the put, for example. Of course, if you're using a different broker, simply log on to your brokerage account, put in your position, and you can put in a limit order. And then what you're going to want to do is come back to Power Options and go Add to Portfolio. When you click Add to Portfolio, if this is the first time that you've ever created a portfolio, excuse me, you'll just have the choice for this new portfolio number 1. And you can click the radio button and give that portfolio a name. And if you've created other portfolios, you can select which portfolio you wish to place this new position in. Now, since I already have one created for the webinars called My Married Puts, I'm going to put the Archer-Daniels position into the My Married Puts. This is not a recommendation or suggestion. I'm not going to enter this trade into my personal account after the webinar is done. This is just a base example on how we use the tools, okay? So, just wanted to make that clear. I'll go ahead and click Insert. And this will copy over again the information for me for that married put position into an entry field. I have my stock, ADM. I'll put in my number of shares. We'll treat this as a paper trade, so I'll just put in 100 shares of ADM. Today's transaction date. and the commission fee. Since it's a paper trade, I'm going to put in 0 into the commission fee. And we've got our 2011 June 35 put. I'll leave that at 1 contract, and again, put my commission fee as 0. If this is an actual trade, you'd put in your commission fees. If this is an actual trade that you enter with your broker, you might have gotten a different price for the stock or a different price for the put option. So you could just put that in as well. Maybe I only paid $4.60 for the put, taking advantage of the bid-ask spread, and maybe at the time the stock was actually trading at $31.72. So just put in your specifics for the trade, and then once you have that entered, click the Submit button, and this is now going to link you into the profit and loss portfolio. Now, why is it so important? Why do we advocate, of course, using the PowerOptions tools and the PowerOptions portfolio tool to manage your positions? Well, it gives you a bird's eye view of all your positions as linked positions. You see at the top here I have 9 married puts, and I know this is a little bit bulky. We're going to do a presentation later in the month. It's just going to be a full hour on using the portfolio tools for the radioactive trading techniques. But I have my specifics, the Archer Daniels and the June 35 put. Stock was purchased at $31.72, and we had the $4.60 put. That's our original issue price. And the stock's at $31.69 right now, so we've lost $3 on the stock. And further bid-ask spread, of course, the position's down to $4.55. So we lost $3 on the stock and $5 on the put right now. Now, what I've done is check the box up at the top of the menu here, this little checkbox for View Position Analysis. That adds 6 columns over to the right-hand side. So let's just take a look at our Archer Daniels position. This shows everything as a combined position. My position cost is $36.32, stock plus put, for the 100 shares in 1 contract in our paper trade. The original expected gain or loss is not available. Why? Because our gain or loss is technically unlimited with the married put. We're letting our winners run, we're cutting our losers short. Now my liquidation value is $36.24. If I sold to close the stock right now and sold to close the put, we would have lost $8 or 0.2%. Remember, it's not like driving a car off the lot right away. What we're seeing here is that we're just losing the bid-ask spread to the call and a slight difference, bid-ask spread on the put and a slight difference on the stock price from when we linked over from the search tool. So we're only down 0.2%. We could liquidate it for a very small loss if we decided to right now. Now the expiration value, this isn't a projection. It's simply saying if the stock is trading at the same price it is right now on June expiration, what would our loss be? Well, what did we talk about before? We'd have the maximum risk of 3.6%. If we held the position all the way to the expiration and the stock was still trading below our put strike price and we made no other adjustments. Okay? So that's what we're looking at. Now, how can the portfolio help us with our management? Now, I'm not going to have time to go into the different alerts. You can set different alerts on the various stock change price, option bid, option chain. You see I have 2 positions where the alert has been triggered. And I think, yeah, we're going to focus on the Altera position here, this paper trade that was open. Let's just review that quickly. The first alert that was triggered, see it's highlighted in red, was Altera. Originally, this paper trade on a webinar on November 17th, 2010, the stock was purchased at $32.49, and the 35 put was purchased for $5. That would have been a total investment of $37.49, and we have the 35 strike put. Right now, the stock is trading at $36.16. We have lost value on our put option. It has dropped about $2.40. The stock's gained $367, or 11.3%, and the put has declined about $240. So we see we have a gain here of about $120. Let's scroll over and just see. What is my liquidation value compared to my future expiration value? All right, so my original cost, again, $37.49 for the whole Altera married put in this paper trade. If I liquidated right now, I'd have $3,876, or a gain of $127 or 3.4% since November 17th. Well, if that matched my goals, if that matched my SIGA model, I might liquidate the position right now. But what's the point of having 10 different income methods if you can't quickly view what income methods are available and compare them side by side? This is the power of the portfolio this is the power of the PowerOptions portfolio when you're using the radioactive trading techniques. Now that my stock has moved up as I expected, what I'm going to do is click the More Information button, those little blue buttons next to the position. I'm going to select Position Actions and then position analysis. The position analysis view, when you're tracking any position in the portfolio, even if it's a covered call, or even if it's a collar spread, for example, we're going to get a breakdown of our original position. Up at the top, I have my original entry price and my put price. I've shown the current stock price, again the break even at expiration, that $37.49 if I hold it all the way to expiration. The original maximum risk was $2.49 or 6.6%, and I still have 163 days remaining to expiration. There's my profit and loss chart over on the right-hand side. And as I scroll down below, I see that here's a better breakdown, or a more detailed breakdown of what we saw in those other 6 columns in the portfolio tool. I have my original position value, my current liquidation value, again 3.4% after 50 days. Does that match your SIGA model? Does that match your expectations and your goals when you first open this position? And then the future expiration. Again, if the stock stays just at 36.16 over the next 163 days and you make no adjustments. Now when we scroll down below that detailed breakdown, we're now going to see some potential rollout opportunities or income methods. When we start off, the first grouping is showing us we can sell a call on Altera, this paper trade, to create a collar. So this is income method number 1. What did we do? We waited for the stock to move up, and now we're going to look to sell a call against it. This is a couple of opportunities. So we have some January calls, some March calls, and some February calls. Let's just take the first one. We could sell the February 37 call for $1.20. Has 44 days remaining to expiration. The max return would be 7.1%, assuming the stock's trading right at $37 on February expiration. This lowers our risk to 3.6%. So we almost cut our risk in half. We started with a risk of 6.6%. We can lower it to 3.6% after the first 50 days by applying this income method number 1. My new maximum risk is shown, and my new break-even is shown as well. Well, it's great to see that monetarily, but if I want to see this more actively by comparing it side by side, what I'm going to do is simply click the More Information button. Again, look at my February 37 rollout opportunity and select Simulate Trade. Now the Simulate Trade field over on the left in red, we have our original position, the current position, the RPM on Altera, stock at $32.49, 35 put at $5. Current return of 3.3 or 3.4%, maximum risk of 6.6%, and still the maximum profit is infinite. Stock can continue to move up in price. Over on the right, we now see the comparison of what happens if we applied this income method number 1, selling the February 37 call against our married put, effectively creating a collar spread. Well, our new maximum risk is lowered to 3.6%, but we did cap our gain. I have a new max profit now of $259, assuming the stock's trading right at 37 on February expiration. And we lowered, of course, our risk. Now, side by side, what does this help me with? Well, the stock has moved up. I'm looking to apply an income method. As discussed in the blueprint, when I'm going to apply an income method, I have to evaluate what my SIGA model is. Not just what has happened now and let me go ahead and jump into something. What I want to see is, well, based on what's happened, what are my expectations going forward? If I'm expecting Altera to continue to move up in price, and over the next 30 to 45 days it might be trading at $38 or $39 per share, I'm probably not going to apply this income method. It's capping my gain. I want to take advantage of more of that increase if it moves up as I expected. So I can go back to the analysis screen, I can close down this comparison, and look at some of the other opportunities that were listed, some of the income method number 4s. Maybe an income method number 6 was available. And then I can run the simulation the same way. So you can see the numbers monetarily in the position analysis screen as you're tracking your married puts in the portfolio, and then you can compare them side by side, and then decide based on your SIGA model, based on your expectations of the stock, does this income method match what I want to do? Does it match my goals, my expectations, and the current conditions? All of the heavy lifting is done for you. You don't have to do the math. You don't have to graph it by yourself. We're doing all that for you based on your cost basis, your position that you entered when you're tracking in the portfolio, and any of the adjustments that are made as well. John, yeah, it is available in the blueprint. I'll send you an email later, and what I'm referring to is that as far as what the SIGA model goes. Nancy, you cannot change or add columns displayed in the portfolio right now, in the profit and loss portfolio. Oops, went to the wrong screen. Give me 1 second. There we go. The only columns that you can choose to change or add right now, Nancy, are the view position analysis. We're going to have a portfolio probably in the spring of 2011. We might have some adjustments rolled out on the portfolio that will allow you to add or change columns. You just can't do that right now. The only thing you can add is those extra 6 columns to view it as a linked position by checking or unchecking the view position analysis box up at the top. Okay. Okay. I'm sorry. Warren. Okay, wanted to know, you mentioned several times this would be recorded and archived. Where is that located? Well, when you log on to your PowerOptions trial account or your subscription, simply click, when you first log on, on the main home menu, you can click on Learning Center. Under that Learning Center menu, submenu underneath the main home tab, you'll see a link for webinars. And you click on webinars, and this will take you to the webinar page on PowerOptions. And over on the right, you have the variety of archived webinars: PowerOptions Tools, Options Strategies, Open Discussions. Most likely, this is going to be placed in that Radioactive Trading archive. It's probably going to replace the PowerOptions for Radioactive Traders that was performed on or archived on September 1st, 2010. So that's one place it's going to be located, Warren. Let me go back here. If you just go to radioactivetrading.com, an easier place, Warren, if you just go to radioactivetrading.com, where the blueprint is listed, the DCDs are listed as well, simply click on the free webinars and podcast link, and here's several archive presentations. And again, this archive is probably going to replace the one from September 1st, 2010. So you can activate it on, access it, Warren, on PowerOptions or on Radioactive Trading. Okay, let's see here. Okay, there's that. I'm just scrolling through here. How often is the platform updated? Well, Ken, when you're on the trial account to PowerOptions, it's in real time. Every time I refreshed that page or ran a new search, you saw new stocks come up into the search view based on the market movements. We do have a 20-minute delayed service where you get your updates about 15 to 20 minutes, or the real-time service as well. Okay, let's see here. All right, going back to Steve's question. I'll go back to the PowerOptions tools for this, but I don't think I'll have time to show a specific example. Steve wanted to know earlier on, can you explain what the effect would be on a married put position in case of a large volatility decrease? Well, large implied volatility decrease, Steve, that would lower my put premium. Let's say I bought into a position, I bought into a married put where my at-risk amount was 4%, which really means I had 4% of time value in the put option. If the implied volatility on that put collapses, what I might see is the time value of my put option might decay from 4% down to 2%. But you know what? The maximum risk is still only 4%. Even with a severe implied volatility crush, I can never lose more than that maximum risk. It's simple math. I paid 4% of time value into the position. I have a guaranteed exit. Even with a volatility collapse or a market collapse, I can never lose more than that 4%. That is worst case scenario. So I think you're confused on something. The percent implied volatility range does not show, it does not come even close to showing if the option is overvalued, undervalued, or a good value or a bad value. All it's showing you is where is the option's implied volatility now compared to where it has been over the life of the option. If I do use the percent implied volatility range when scanning for puts, I'm probably looking for a range of blank to 80, less than 80 or less than 70%. What that means is I don't want to see put options where the current implied volatility is near the higher 70 or 80% range. So in case there is a decline, as Steve just asked, I'm going to avoid some of that decay. If I bought it when it was near its top, then I might suffer from a lower price in the decay. Yes, Don wanted to know, can you check for implied volatility and historic volatility of an option? Well, historical volatility applies to the stock, but the historical values of the implied volatility, that's sort of taken account with that percent implied volatility range, Don. But real quick, one of the other features that you can access in that more information menu when you're back on the search is the research menu. You can do detailed stock research or click on the option research page. The option research page is going to show you all of the data that we have for the particular option. So over on the right, for example, we can see here that my implied volatilities are listed for us on this research page. My percent implied volatility range, where the options implied volatility now is at 0.30. It's been between 0.26 and 0.32. I have my Black-Scholes ratios for the 20-day, 50-day, and 100-day. Now down below that, Don, on the research menu, the detailed research page, what you're seeing here is since the option was released on the market, since the option was traded, we have a historical graph comparing the option bid price to the historical implied volatility. So I can scroll back over time here. I'm just scrolling through, wait for the screen to catch up. There we go. So I'm about the halfway point. I'm still comparing our implied volatilities here in the red to the option bid price on the top. And you can just keep scrolling further back. There's not a lot of change you see in this particular spread. So you can look at the implied volatility history. You can screen for the percent implied volatility range, which reflects the history in that. Luis wanted to know, how can the backtest be used to support any trade decision? Well, what the backtesting does is exactly what we just saw in the search tool. I can go back in time and screen specifically against any positions against my criteria set. Once I've identified those positions, I can then fast forward the group and see how they perform to expiration, and I can look at the stock chart as it performed during that time, and that might help me decide, well, would I have used income method number 1 in this scenario? Might I used income method number 4 in this scenario? It doesn't do it manually. It doesn't do it automatically. It's not automated. You still have to do some of the work, but it's a really easy way. Now, what I would mention to you, if you want to see exactly how you might be able to use those historical suite of tools to help you and how they can help you with your back testing, again, go into that webinars menu on the PowerOptions Learning Center. Go to PowerOptions Tools Archive, first header there, and the 4th presentation is a full hour on using the PowerOptions historical suite of tools. Dieter, I'll send you an email after the webinar as well. Hold on one second, I'm just writing down a few things here. Okay, let's see here. Don says, okay. Okay, Don, yeah, just let me know if you have any questions. Remember, anyone who's a trial member or a subscriber to PowerOptions, you can sign up for the free coaching session. Let's just go back to the main home menu. So if you're on a trial through the Blueprint, or if you're a subscriber to PowerOptions at any time, from when you first log on, click on the free coaching session menu, and you'll see the available times. If you're not available during the trading day, I know a lot of you work, and I appreciate you joining me, and I'm sorry I went over time. This is about an hour and a half here. If you think you need to schedule a time that's off hours, send us an email or give us a call, and we'll try to work something out. I can't guarantee that I'll be free off hours or over the weekend, but if you give me maybe 3 or 4 days notice, we might be able to work something out where we could do a session over the weekend. But typically we try to do them during market hours, and just use this scheduler to schedule that free coaching session. And remember, I won't give you direct advice on your trades or tell you what positions to enter or what puts to select, but I'll walk through all the math with you, discuss the guidelines, and of course, one-on-one, walk you through the tools based on how you would like to use them and how you would like to apply them. All right, well, ladies and gentlemen, that is our presentation for this afternoon. Remember, as I mentioned, let me just scroll down to the end here. If you think of any questions later on, please send me an email. I'm just trying to get to the end here. I'm sorry. Please send me an email to support@radioactivetrading.com or support@poweroptions.com if you have any questions about the PowerOptions suite of tools. Remember, you can call us here at the office anytime during market hours at 877-992-7971 or reach us at 302-992-7971. Looking at the time that we spent, I thank you all for staying with me. I know we went over time. Just thinking maybe I shouldn't have done that 15 minutes at the beginning just reviewing the RPMs, but that's okay. This will hopefully be up later this afternoon. This presentation will be up later this afternoon in those archives. And as I mentioned, just keep an eye out, because later on this month, later on this month, we're going to have some special webinars on an hour presentation on just using the PowerOptions portfolio tools for the RPM positions, and maybe an hour presentation just on the search tool, so we're not trying to combine too much into once. All right, ladies and gentlemen, thank you for joining us.